guys. Hello guys. So today we'll be talking about moving average envelopes. We'll talk about the moving average itself, calculation of moving average, applications of this moving average, advantages and limitations to the moving average. What is a moving average envelope? Now, a moving average envelope is a technical analysis tool that consists of two parallel lines or envelopes because it looks like an envelope. Now, it's positioned above and below the central moving average. Now, these lines are calculated as a percentage deviating from the moving average. Now, it creates a visual channel that helps traders to identify potential overbought and oversold market conditions and anticipates price reversals. Now, the advantages of this envelope is the price boundaries. Now, it makes the traders access the potential range of the price market. So you can easily see the ranges of the price market from one end to another. Now, identification of these overbought and oversold conditions. Now, when the price touches the upper band, it signals an overbought, signaling a sell. And when it touches the lower band, it signals an oversold, signaling a buy opportunity. Now, it has a dynamic response to volatility, and increased volatility. When this volatility increases, the band increases with it. So it's directly proportional to the movement of the band. Now, when the volatility decreases, the band compresses. Now, it's very easy to implement because it has an easy implementation and interpretation to it. Now, the little bit of limitations to this envelope is that it provides false signals in trending market as it follows the volatility of the market. So sometimes there are a fake out, which I had explained in my previous classes, and sensitivity to the market condition. So since it follows the volatility, it's obviously quite sensitive to the movements of the market. And due to it, it's not suitable for all market conditions because not all currencies are very volatile. We have some currencies which are with high volatility like gold, and we have the moderate volatilities like pounds, US dollar, JPY, and then we have the least volatility pairs like we have RBX, we have the Arabian currency, we have the Russian currency, and South African currencies, and much more lower, less volatility currencies, which are among the exotic. And let's pinpoint. Let's pinpoint the most important things for using an envelope, a moving average envelope. One, it helps you confirm the trend condition. It means the show upper. If it shows the upper band, it means it's an overbought condition, and the showing on the lower band shows an oversold condition. And when the envelope moves towards the upper direction, it's an uptrend, and when it moves on the sideways, it's a consolidation. So here on this picture, we have an uptrend confirmation. As you can see, the band helps give you a clearer insight as to the direction of the market. So we have traders, new traders who find it difficult to identify trends. A moving average can help. And for all the traders who are quite new to it, which still find moving average noisy, they can also use a moving average envelope to help identify the trend. And as you can see, the moving average envelope made it a lot more cleaner in the market, a lot more clearer in the market, as you can see the identification of the trend. And as you can see, I have highlighted it because it's going up, means it's an uptrend. And you can see a minor consolidations on each impulse movements, and we have the corrective consolidation. So that is an uptrend for the moving envelope. And the second picture, you can see we are in a downtrend. The envelope just makes it so precise. It makes it so easy to understand, makes it so functional, and I like it. When you're using if you're using an envelope, it helps you. It's like a package. When you put, gift thing, you have a gift box in the envelope, you have some sweet exotic note you have to give to your guy or your woman, whatever gender you are precise in the picture. So it comes with beautiful gift, and that's why it's called an envelope, because then the edges of this envelope can help you identify where the trend direction is very easily without having to think too much about it, without having to grab your tools and having to draw lines and think about much more things. The envelope just helps do the trick for you. So for people who like to make things a lot more easier for them, you can use the moving average envelope to help you do this. And there we can see it signals the downtrend. We have the blue line for the moving average, and then you can see the parallel lines, which are the boundary lines that calculates the percentage of these periods of the moving average, because this is exactly what the boundaries are. It calculates the percentage of the moving average. So we can see this is a downtrend. And the third picture, we can see we are in a drop base rally. But what we're looking at most importantly is that this moving average envelope shows us exactly the idea that we're in a side trend, because you can see there is not much volatility. It goes up and it goes down, and it doesn't have a direction towards it. It still stays in the center zone. So we are in a side direction. If you want to know more about our trends, you can read my trend classes in my previous video. So on the fourth one, how can you trade using moving envelopes? So how do you trade using moving envelopes? Now we've known the first idea of a moving average envelope, which is to confirm trend directions. Now, and you also know that when this price touches the upper part of the envelope, it signals an overbought, which gives an idea for a sell. And when it touches the lower band, it signals an oversold, giving you a signal for a buy. And now we're in an uptrend. Like if you remember my previous classes, I told you don't want to sell in an uptrend. You want to buy in an uptrend. So what you'll be looking for, if you see the market is going in an up direction, you wouldn't want to look for a buy because you see it's up. You would want to wait for it to come back down before you take a buy, because you're sure you're in an uptrend. So now, since the idea of this envelope is to look for oversold and overbought condition, so we'll be looking at, in an uptrend, you'll be looking for where the price comes to touch the lower band in an uptrend. Do you understand it? Wait for the price to come to the lower band in an up direction and then take a buy signal, or then take a buy action or a buy execution. So you can see we're in an up direction, it goes down, and then we take a buy. And then it comes down again, you take a second entry buy, or if you had taken in the first one, you wait for it to go. And then you see it goes up, and then it makes a correction. If you don't know what a correction is, go to my trend classes, it will help you. And then it comes down for a correction, and then you take another buy, and that's how it goes. Now, likewise for the downtrend, because you can see the envelope shows a downtrend, you will be looking for a sell signal in a downtrend. You would not want to buy in a downtrend. It's obviously crazy. I mean, it's like throwing your money away. So what you'll be looking for is waiting for the price to get to the upper boundary, or which is the upper line of the moving average in the moving average envelope, and look for a sell signal, which is obviously a signal for an overbought condition. So as you can see here, the price goes up towards the up band, and then you look for a sell. And then it goes down, you hit your high profit, and you wait for a correction phase. And when it goes for a correction phase and goes up, and when it comes to the band, you sell again. And you keep repeating this process till the trend finishes, till it gets exhausted, till it comes to a consolidation or it changes direction, and then you swap. So here we have a side direction or a side phase or a consolidation phase. So in a consolidation phase and side phase, it doesn't have an intended direction, since it doesn't go up. Since it's not an uptrend or downtrend, you'll be looking to sell on the top and buy on the bottom in a sideways trend. So you can see when the price goes up to the parallel line, it's not every time it does obviously touch the line, but it has to come close to it. So when it goes to it, you sell, and then it goes back down, and then you buy again, and then it goes up to the line, and then you sell again. You keep repeating this process in a consolidation till it changes trend, and then when it changes to an uptrend, you'll be looking for a buy when it comes to the bottom, which shows an oversold condition. So basically, guys, this is very easy. This is how you can use a moving average envelope, and how can you set this moving average envelope? How do you set it up? It's very simple. You just, in your trading view, all you just have to do is locate the indicator. When you click on the indicator, you see a search button, you type the moving average envelope. You see I already highlighted it in my previous class about the moving average. So it's already there, a moving average exponential, which is there, and a moving average envelope. You click on the moving average envelope, it pops up, and then you can click on the settings, which I've highlighted here, and then it pops up the moving average envelope settings. So you can put it on whatever percentage you see fit. There's no accurate percentage that is 100% good. So if you ever see where they say 100% settings for a moving average envelope, it's a lie, but we do have some default settings. Here you can see I have a 1% shift. People use a 5% shift. Some people use a 7% shift. So it all depends on you. You need to do much more deeper research as to what is much more comfortable for you. But I usually advise that people who use moving average envelopes should be more of option traders or traders who are looking to scalp in the markets, due to its trade bias, due to its false signals in the trending market, and sometimes lagging in identifying trend reversals. So I usually advise it for scalpers, because you wouldn't have to wait for a long time. So once it gets to the boundary of the moving average, to the boundaries of this moving average on the top, on the bottom, you look for a buy and you look for a sell. And when it gets to the other end, you quickly close your trade. It's very simple. It's much more very efficient for scalpers and option traders who trade by the minute, who bet on the price will go up in 5 minutes, 5 seconds, 2 seconds, and so on and so forth. So I'll see you guys in the next class.